market's been a busy day for real estate data. We've learned that Manhattan apartment rentals more than doubled in the second quarter, and overall apartment vacancies around the country have come down from a 30-year high. But as we reported in the last hour, luxury vacation home sales have faded as the economy has struggled to recover. Joining us now to make sense of the mixed picture is Sam Chandan. He's global chief economist with Real Capital Analytics. Sam, also a professor of real estate at the University of Pennsylvania's Wharton School, and he was also named among most influential in real estate by Multi-Housing News magazine. Sam, thanks for coming in to talk to us about all the numbers. Doing well, thanks. So, apartment vacancies in the U.S. overall down in the second quarter. That's the first quarterly improvement in 2 years' time. That sounds like good news. Is it good news?
I think it is. There are a couple of different things going on here. As the economy has begun to improve, there are families that have felt a little bit more comfortable branching out into their own apartment. That may be young college graduates, graduate students who have been bundling up, staying at home with their parents, who, because they found a job, maybe are renting for the first time. We don't want to overreach on that, however. When we look at the labor market numbers, it's clear that we're still very, very early in the recovery in the job market. That's still a very tentative trend. And so there are a couple of other things that are going on as well. One is that in many markets around the country, particularly in the Sun Belt of the United States, in Florida and Las Vegas, one of the major trends over the last couple of years has been the introduction of what would have otherwise have been condo buildings that have ultimately been completed and come online as apartments. That introduction of new inventory has started to taper off in the last couple of quarters, and that's made it a little bit easier for that apartment vacancy rate to come down.
So it's not just a demand issue, it's a supply issue as well. What about people who, I mean, if you're reading this sort of on the negative side, what about people who might have been considering buying a house, now they're not, and they've decided to rent instead?
That's absolutely an important piece of this. Part of what's happened over the last couple of years as the federal government, as the Federal Reserve and various other policy bodies have worked to help to stabilize the single-family housing market. We've had very low mortgage rates. Credit is still tough to get, but there's been a concerted effort to move people into housing and stabilize conditions in that market. When you take someone out of the apartment market and help them to become a homeowner a little bit earlier, that tends to undermine some of the outcomes for rentals. Vacancy rates might rise as a consequence. The impact of those federal government programs has started to taper off as well. There are fewer new initiatives. For example, the first-time homebuyer tax credit has now come to its conclusion, and that's helping to stabilize what we would refer to in economics as the tenure bias, when people are making choices between, well, do I want to be an owner right now? Do I want to be a renter? And when do I want to make that transition?
You mentioned mortgage rates, and I want to quickly ask you about that. Record low for the third straight week. Why isn't that getting more people to buy? As we know, the new home sales and the existing home sales numbers have not looked good recently.
Absolutely. I think there are a couple of different things going on here, and you can see this in a whole variety of aspects of the market. We know that activity really did pick up earlier this year. Part of the reason for that was certainly the more stable economic outlook as compared to where we are now with some new uncertainties, but also because as the Federal Reserve was tapering down its purchases of mortgage-backed securities, they had a big program, $1.25 trillion, that recently ended, and because the expectation was that rates would start to rise as the economic conditions improved. There were buyers across the spectrum who were working on the expectation that later in the spring, later on this year, mortgage rates might start to rise. And so they were, in part, buying a little bit earlier. That effect has worn off.
Maybe they're regretting those decisions a little bit.
Possibly. I think people are not necessarily seeing that the value of the home that they just purchased has fallen precipitously. So if they're taking a longer-term view and their sense is that the value of that asset's going to improve, then they might feel a little bit more comfortable. But the thing that hasn't worked out or hasn't played out as expected is that these rates remain very, very low. Just as we didn't necessarily expect that there would be a flight back into treasuries, a flight back into mortgage-backed securities because of the instability in Europe, the prevailing expectation that mortgage rates would start to rise isn't one that has played out. All of those purchases have kept mortgage rates very low.
Right. Okay, Sam, unfortunately, we're out of time. Sam Chandan, Global Chief Economist with Real Capital Analytics. Thank you so much for joining us. Appreciate it.